Now let's go ahead. Let's hear what Tom Lee had to say here just about an hour ago.
And head of research, and he's a CNBC contributor. It's great to see you.
Yeah.
I want to start in a little bit different way than normal because Doug just made a really interesting point about millennials and how they're so conservative in their positions. And whether you've experienced this phenomenon firsthand or not, what do you say to those who need to be coaxed into a market that is ever at record highs after a run in stocks like NVIDIA, like we've rarely before seen? I mean, is the water still safe?
I know investors generally aren't comfortable buying things at a high, but if we're mid-cycle, which we probably are, then we're going to be making a lot of new highs over the next 5 years anyways. And I think there's a lot of statistical support showing buying at new highs actually has a better win ratio than attempting to buy at lows.
Well, it's also true that for all of our lifetimes, the stock market has generally gone up. So yes, there are pullbacks. Yes, there are corrections. Yes, there are financial crises. Yes, there are pandemics. But is there any reason to believe that the fundamental nature of the beast has changed for the worse? I mean, I read this research sometimes, I'm sure you've seen it, that says, oh, we're going to have permanently lower stock returns now. 4% a year is the most you should expect and things like that. We've pulled forward gains. I mean, do you believe there's credence in any of that?
I've heard that exact statement about the new era of low returns since 2008.
Right.
And stocks have compounded at pretty much the historical average since 2008. I think as long as there's skeptics out there, that means there's a lot of fuel for upside.
Mm-hmm. So is NVIDIA the thing that you look at and go, well, this could spoil the party, i.e. it becomes too much of a good thing. It really starts to lift into some kind of bubble, draws people into the market, really extends valuations, then we have to clean up the mess.
There's a lot of people trying to top tick NVIDIA, saying that they don't want to own it because it's expensive, but it's a 30 PE stock that sells something that no one else actually produces in the world.
The one thing it's not is expensive.
Yeah. So I'd say I'd feel very differently if we were discounting NVIDIA being larger than global GDP and at 100 PE, and everyone's saying there's no way it can be stopped. But because everyone wants to sell NVIDIA and try to call a top, I actually think there's still a lot of upside.
When I hear
exactly, that's the thing with NVIDIA here is the valuation is not, crazy on this stock whatsoever. We go ahead and pull this baby up here on 1000xstocks.com. Forward P52. And keep in mind, this is taking into account analysts' expectations, right? And what has NVIDIA been doing? Crushing analysts' expectations quarter after quarter after quarter. So a good probability that forward P is probably actually in the 40s right now, right? Which, is it above the market? Sure, but the NVIDIA's growth is so far exceeding the market, right? It's not even close. And you look at a two-year out forward P, 35, it's probably closer to like a 28 or a 30, right? Which isn't that far above the market, and with growth rates significantly exceeding the market. So that's the exciting thing with NVIDIA, and that's another reason why I say this run's probably not done yet, is you haven't pushed that valuation to something that is like, whoa, this is insane, like this is crazy, like I can't believe NVIDIA is trading at this sort of forward P. It's not there yet. When you're exceeding the market growth rates by 10, 10x, 20x, 30x, 50x, to be trading at 2x or so, a forward PE is not crazy at all. So that's why I think NVIDIA could go to a $4 trillion or $5 trillion market cap before it kind of has a 2 to 3 year top. I think there's actually a decent probability of that. We've got a lot more multiple expansion there. So just some food for thought.
When I hear anecdotes, like I heard at a fundraising thing the other night about how all the local kids own NVIDIA, what should I think when I hear that kind of information?
Well, it makes sense. I mean, NVIDIA is the largest stock, so everyone should own it. It's almost like if someone said, I'm selling because everyone owns the S&P. Everyone should own some S&P. It's really a bearish sign when someone says the S&P won't ever go down. And I only hear people saying the S&P's topping right now.
I do remember people saying stocks never go down a couple of years ago. Then we finally had a correction. I think we've had a couple maybe since then. What kind of paradigm are we in now? We hear people saying, like Mark Zandi did, well, the Fed needs to cut because otherwise the economy could take a turn for the worse. We know rates are probably higher than they need to be. Do you need to have a view on Fed rate cuts in order to support stocks continuing to move higher?
To an extent, I think that the big lesson for the last 2 years is the S&P has endured some pretty severe rate hikes. So we know companies are managing this cycle well. If the Fed turns neutral or dovish, that's even more positive for stocks. So I think that the environment for equities still is good because they survived a stress test. It's only bad if the Fed has to raise rates.
What makes you think we might be mid-cycle and not later stages?
Well, there's a lot of things. First of all, leverage is still quite low. If you look at debt service ratio, I mean, it's not associated with business cycle peaks. It's actually more early cycle. If you look at the ISMs, they've just turned positive. That's generally an early cycle sign. I think the only thing that's late cycle in people's minds is that we made an all-time high, but S&Ps are going to make all-time highs mid-cycle, and they're going to make it all the way through late cycle.
Did AI bail us out? Because sort of thinking back to this dispersion that we've seen, okay, so the biggest names have all the earnings growth, the biggest names have a lot of the market growth, and everything else is a little bit more lackluster. And you just think, okay, if you rewind...
I think it would feel more late cycle if the Russell had been running, small caps had been running, and stocks in general were doing great. And the just reality is the stocks in general are not doing great. There's so many stocks that are at multi-year lows right now, near multi-year lows, near 52-week lows. The Russell hasn't done anything in years. I mean, we're talking about if you pull up a 4-year chart on the Russell, it's, you could even go back to prior to Rona, which is 4.5 years ago, right? You could pull up a 4.5-year chart of the Russell. It's hardly gone up since then. You can pull up a 3-year chart of the Russell or a 3.5-year chart of the Russell, and it's down significantly. So therefore, you look at that, you look at smalls, you look at the Russell, you look at some of these other stocks, and you're like, that doesn't feel late cycle, to be honest. If S&P at all-time highs, Russell at all-time highs, and everything like that going on, then you might feel like that.
We were still working through post-pandemic gluts. You know what's been going on in the manufacturing sector. It's been a recession for 2.5 years. So did we get bailed out by AI? Is that what's extending the cycle?
I think people are doing some fake math. Also, 45% of the S&P has more than 10% earnings growth right now, which is the highest ratio in 3 years. Wow. 1 in 6 stocks is up more than 20% this year. 1 in 4 stocks is up more than 15%. I think people are distorting the fact that there's negative earnings coming from energy, basic materials, and healthcare. That's how you get that negative 7% growth outside the top 10. But healthcare is flipping in Q2 positive, energy is flipping positive in Q2, and materials. So the number of companies with double-digit earnings growth is going to really soar, actually.
So final question, to sort of ask the what would make you bearish question, I mean, does the trend have to break significantly for you to say, okay, fine, maybe if something like a mid-cycle correction is here, or does the economic data have to change, or some exogenous shock?
Well, I think that 3 signs of a peak are when incremental return on capital is 0. So when we are at a peak CapEx cycle, I don't think we're anywhere close. I think when we are extended on leverage, so whether it's debt service ratio or margin debt's still 20% below where it was in October 2021. And I think when sentiment turns, what you mentioned, and when people say that this market's unstoppable and won't ever go down, then I think we'll have a big drawdown.
But we are not there yet.
Yeah.
Tom, great to see you. Thanks for your time. We appreciate it. Tom Lee, Tyler.
Okay. Hey, I want to thank you for watching this video here today on the Clips channel. I want to introduce you to 1000xstocks.com. This is the most valuable service you're going to find out there. If you're an investor in the market, this is a tool that's going to help you immensely get to the next level in the market. So when you're looking at 1000xstocks.com, you're able to understand all the different metrics laid out exactly how you need them as a long-term investor in the market. So let's say I wanted to look at a stock like Palantir. I can go ahead and type in Palantir right here, and it's going to say all Palantir's different metrics right here. Let's say I want to go ahead and look at a stock like Tesla. I can go ahead and type in Tesla right here, search, it's going to give me all Tesla's metrics right there. Let's say I want to look at a stock like PayPal. Go ahead, search it up, and then it's going to give me all PayPal's numbers laid out right there. Compare feature is one of the most valuable features of any service literally in the world. And the reason being is you're able to compare 3 different stocks all next to each other in a matter of seconds. It's absolutely, there's no service you're going to be able to find something like this. So let's say I wanted to find out, what do I think is a better buy? Do I think it's Meta? Do I think it's Google? Or do I think it's, let's say, a stock like Microsoft, for instance, right? So I can go ahead, type all those in there, and then hit compare, and boom, in a matter of, what was that, a second or two, it gave me all the metrics out. So now I can say, okay, Meta's forward P is trading at this, Google's forward P is trading at this, Microsoft's trading at this, and I can go ahead and understand this on a very high level. Additionally, we have earnings calls on here as well. So if I need to listen to any companies I own or am researching their conference calls, I can do it right here through the service. So let's say Tesla, if I want to pull up Tesla's latest conference call, boom, I can play it. I can adjust the speed as well. So if I want to listen to it at 2x speed, I can listen to it at 2x speed, 1.5x. I also have the transcripts of the conference calls as well right here. We're also working on a lot of different new features behind the scenes. So if you would like to apply for access of 1000xstocks.com, go to 1000xstocks.com and you'll be able to fill out an application and go from there. Let's get into this.
Fitzgerald and Unlimited's Bob Elliott. Guys, happy Friday. Bob, you think this expansion can go on for a while, even if it's paused today, because we don't have a persistent situation where yields are up, stocks are down, slower spending. Why does that mean this can go on? Why is disaster not like right around the corner?
Well, I think from a real economy perspective, we're seeing a situation where income growth remains relatively healthy. You're seeing good wage growth. That's translating to good nominal spending growth. And that's keeping the economy going and powering on. The trouble is it's a little too much in terms of inflation, which is a bit of a concern for the Fed. And it's also probably not quite strong enough to meet those sort of extreme earnings expectations that are being priced into the equity market as we move to the back half of the year.
But do you think this is
Well, hold your horses for just a moment. That's a case-by-case basis. Certain stocks are going to power right through regardless of kind of if the economy is like that good, that strong, if inflation's at 3.1 or 2.7 or 2.5. Certain of these companies, as in the one we're watching in front of us, Meta, many others, Amazon, they're going to power right through this year and report great numbers. Now, there are some other stocks that are much smaller market caps in the market that, will struggle a little bit, right? And that's why you're seeing also the major insane divergence between the biggest of the bigs and then everything basically underneath that, right? It's kind of the rich get richer, right? It kind of reminds you a little bit of society in general, where the very top gets the most, and then everybody else doesn't have that most. And that's how, honestly, the stock market feels, does it not? Crazy
situation still, relatively speaking, for stocks?
Well, I think in general, as long as we continue to have decent nominal growth continue, you're going to have certainly a range of sectors where we'll continue to see, continued earnings growth, continued momentum. The real question is, where are those extremes in terms of pricing in very, very high earnings expectations, and how are those going to really be achieved? How are you going to get stocks with 20, 30, 40% earnings growth expectations in the context of a 5 to 6% nominal GDP growth? That's a little more questionable, and I think we're starting to see maybe some questioning about how extreme those expectations are relative to what the reality might be.
Okay, speaking of questioning, Eric, you seem to be calling a top in this AI hype, and you think stocks are going to move sideways from here at best?
Yeah, so I think we're at a short-term sort of tactical top in this frenzy that we've seen over the past month, where the upside has really accelerated. If you look at the largest cap names that have reported earnings in May and June, you've seen a situation where estimates have risen by anywhere from 0 to 7%, yet you've seen stock prices in these mega names rally anywhere between 15 and 50% over the course of the last month. And we think it's gotten a little bit ahead of itself in the short term. So we look at some short-term indicators. If you look at the RSI and the QQQ, it's gone above 80. We've back tested it. It happens very
RSI, Relative Strength Index.
Infrequently over the last 25 years, but when it has happened, about half the time you've seen a meaningful downside, meaningful sell-off over the next month. If you look at the narrowness, even within the NDX, the equal weight versus the cap weighted NDX, that's also gone to extremes. We're not a big believer in breadth being a indicator overall, but the extreme nature of what we've seen over the last month is causing us some concerns. So this is much more of a tactical call. As you know, this has been the part of the market we've liked relative to cyclical, small cap, and everything else.
Yeah.
But we just think in the short term, it's a little bit extreme.
Because
Relative strength indicator, by the way. Before we go further here, how do I feel about this call of like, tactical top here, maybe thinking about positioning out of some of these stocks, right? Let's say in NVIDIA. Let's say you think we got a tactical short-term top in and you think it's going down to 115. So you're thinking, okay, get out, at 126, 127, whatever, right? Go ahead and buy back when it goes to 115. What do I think about that strategy? I think it's very flawed. I think it's a bad strategy overall. NVIDIA could very easily make a move to 150, 175, and then you're not part of that train, right? And so I think making those sorts of judgments and decisions to, okay, I'm going to get out of these, then I'm going to buy them back. It sounds good in theory, but in reality, it doesn't really work. It would be nice if it worked, but it just doesn't work. Like every once in a while, it might work, right? And you might say, oh, I get out 126 on NVIDIA, get it back in 115, ride it to 150. It all sounds good on paper, and then the reality happens, and it's like, oh, this is a little tougher than I thought, right? It's a very frustrating situation if you want to be long NVIDIA or any AI stock. Let's say it's a Palantir. Get out of Palantir at 23, hope you can buy it back at 21 and ride it then 27. I mean, sounds good on paper, but it's a lot harder in reality.
People are going to remember that you were bearish for a while at the end of last year, I guess through last year. That wasn't quite the right call. You adjusted and said, actually, I like the mega caps, relatively speaking, but now you're adjusting again and seeing even those mega caps have gone to extreme?
Yes, exactly. I mean, when we think about the market on a market neutral perspective, for the past year, we've liked those big secular AI levered names and have said to be underweight sort of everything else, in particular cyclicals and more mid cap names. And, the reason why we have concerns around the cyclicals and mid caps is because, and small caps is because they've got, more leverage. They don't have the secular tailwinds and are much more subject to the actual economic growth and the headwinds that Fed policy is putting on this market. But now we just think from a tactical perspective, as we look out the next month, we think there's risk of a decent reversion in a lot of the very loved names. I mean, if you look at the money that is piled in over the past month into growth funds, you look at some of the declines in short interest, it kind of creates risk right now that I think we all need to be wary about.
Yeah, I think, if we're talking NVIDIA specific, I think it's dangerous to assume you can get out of this one, get back in before it makes another run, because this stock is just, any dips this stock gets, people want to buy it right up. Don't be surprised if NVIDIA gets bid up this week. Don't be surprised if NVIDIA gets bid up. And next thing you know, it's right back to 140. Don't be surprised. Now, a lot of people are still very underweight this stock. Keep that in mind.
Yeah, under pressure once again today, ending the week lower by 4%. But our next guest just raised his price target on the stock for the 5th time this year.
So down 4% for the week, but from right here, very important you understand this, the stock's down about 10 percentage points. So in a matter of about 48 hours, the stock dropped about 10 percentage points.
This time from 125 to 160. Let's bring in Melius Research, Head of Technology Research, Ben Reitzes. Ben, happy Friday. The other two $3 trillion stocks in the market right now had to go through these transition periods, most recently for Apple from iPod to iPhone, for Microsoft from Windows to being a productivity company overall. What's the transition that you think NVIDIA has to and can make to maintain and grow this $3 trillion market cap to 4?
Well, I think that they're the closest thing to nailing it in AI so far, obviously, by creating an ecosystem that developers love and they know they can be relied upon to grow. And that's a really big thing. We are in a paradigm shift. And, this is the Microsoft and Apple of those past regimes all combined into one in NVIDIA. And that's what you really have to think about and really just starting. So they may have the most runway of all the big ones, but what they need to do is transition more to software.
Keep in mind, in regards to NVIDIA, there's a lot of weighting changes that are about to transpire in July. And there's a lot of funds that have to kind of rearrange things. Let's just call it that here over the next few weeks and then into July, because July starts a new quarter, okay? And so NVIDIA is going to be, I would call it extra volatile for really like the next month as we finish out June here. And I think that's part of the reason you've seen such wild moves where it dropped 10% in a matter of, it has nothing to do with the fundamentals in a matter of 2 days. It's strictly like all of a sudden a fund's like, okay, we got too overweight this position. We need to take some profits here, redeploy. And then you're going to also see on the buy side, you're going to see a lot of money come into NVIDIA stock also over, we can call it the next, really I think it starts a little bit more in July, but you'll probably start to see it even some this week coming up here.
Going to see. And also, I think what's really cool, and we wrote about this today, is they could generate over $270 billion in cash over the next 3 years. And nobody talks about that. That's something that can come back to shareholders and really keep the multiple pretty high for a long time. So we like what we're seeing, but eventually people are going to be talking about this massive cash pile.
Well, arguably, then, only 2 companies became mega caps out of the mobile revolution, right? Apple and Google, and then only 2 became mega caps out of the cloud.
I don't agree with that. There's a lot of companies that became absolutely massive because of that. I think Meta's one of those companies, right? They become massive. Amazon's one of those companies. If you look at Amazon prior to the mobile revolution, so let's call it prior to 2008, right? Amazon was just really seen as kind of like a play on, just a play on kind of e-commerce websites, right? And then it obviously became the mobile app. And then on the AWS side, that really took off like insane because of the mobile revolution, the app revolution, right? And so many of those massive companies, the Ubers and everybody else that ended up being built on AWS, right? Think about Netflix. I mean, I just think his point is not a good point. I mean, so many companies became monsters because of the mobile revolution.
Amazon and Microsoft. How many mega caps are we going to get or maintain out of the AI revolution?
Well, we're not sure. I mean, right now, we still think, obviously software has had a few good days, but NVIDIA is doing something amazing here. They are creating AI factories, which is really code for software factories. And their output is software. It's applications. It's stuff that we take for granted today in a different form. And NVIDIA end goal is to create software on the fly. That's their product that they're going to create with these AI factories. And that's just a ton of value, John. If they get this right, there are trillions of TAM that should go to them, not just the trillion that Jensen talks about. If you're creating software on the fly, eventually, that's very valuable. So, obviously, NVIDIA, we've been talking a lot about Broadcom lately. You probably saw our report there. A lot of folks are looking for the second one. Broadcom's in a really good spot with the CapEx for the custom silicon. So, they're probably the closest one in terms of thinking about who can be next. And then AMD's the dark horse here. Okay. On the hardware side, we've been pushing Dell really hard. You know that.
Yeah. What kind of software companies get destroyed when you're...
So let me say something that's very important here. Everybody understands this, okay? Listen, a lot of times you're best off just playing the big dog, playing the main company. Think about, like, imagine you were trying to play social networks, right? And you're like, oh, this is going to become big and even bigger over time. Okay. You could have decided to play against Meta. You could have played Twitter back when Twitter was a public company. You could have played Snap back when Snap was a public company, right? Snap still is a public company. And ultimately, really poor decisions. You should have just stayed with Meta. So you can try to get cute and think you're going to play this. At the end of the day, like, look at Pin's total returns over time, right? Honestly, you would have just been better off playing Meta, the big dog of the space. And so when it comes to NVIDIA and it comes to all these chip makers, the best play might still end up just being NVIDIA long term. You might try to get cute and think you're going to be able to play this company, that company, that company. At the end of the day, you're probably just better off just playing NVIDIA.
Creating software on the fly like that.
Well, the kind that don't talk to me anymore. That's really a joke that some of my clients will like. But, I think that the software companies had it really good for many years. They really nailed it. And they were the big beneficiaries of the cloud. And then they transitioned to SaaS. And they sort of right now are in the early innings of seeing they just can't, price forever. They've been raising prices on everybody since COVID and beyond, and now they want to charge extra for AI. Let's see how that goes for these guys. Other than Microsoft, it's really hard to pick a winner. Of course, you could have some trading days. Salesforce, a good company. Adobe's a good company. But we think it's pretty tough. AI allows a lot of startups to get going that maybe wouldn't have otherwise. And then a lot of competitors get stood up. But in general, where we're going is applications are going to be stood up quicker than you ever thought. It may take several years, but that's the end game.
Yeah, that's fair.